This is my time. I'm on the rise. Can't hold me down. I'm too fly. This is my
Welcome to
time.
episode 9 of the Physician Wealth Framework series, Understanding the DNA of Deals and Equity. You've probably seen this before. A flashy deal deck, big projected returns. A friend says, you should really get in on this. And you ask yourself, should I wire the $100,000 into this deal? But deep down, you feel unsure. How does this really work? When do I get paid? What if it goes sideways? This episode fixes that. You're going to learn how to decode the DNA of any private deal, real estate, private equity, business investments, so you don't rely on trust, hope, or hype. Let's break down how the wealthy evaluate deals and what most physicians miss. Let's be honest. Most physicians aren't trained to think in terms of equity, risk, and structure. You're trained to save, max out your 401k, let someone else manage it. So when a private deal comes across your desk, you might glance at the return, rely on the referrer's credibility, skim the pitch deck, and hope it works out. But the truth is, wealthy families don't hope. They underwrite. And the number one reason physicians lose money in deals, they don't understand the deal structure. Let's break it down. Every private deal, whether it's real estate syndication or a healthcare business, has 5 components. Here's how the wealthy dissect them. Number 1, equity versus debt. Equity is when you're an owner. You share in the upside. You take on more risk. Debt is when you're a lender or the bank. You get fixed payments, no upside. You must know what you're buying and what your role is. Number 2, preferred return or the pref. A preferred return means you get the first slice of profits, typically 6 to 10% annually, before the sponsor takes their cut. No pref is a red flag. You're exposed and they're not aligned. Number 3, profit split or the promote. After the pref, profits are split. It's called the waterfall, often 70-30 or 80-20 between investors and the sponsor. Questions to ask. Is this split after my pref? Is there a hurdle? Does it incentivize real performance? And number 4, the capital stack. This tells you where you sit in the payment hierarchy. Senior lenders, mezzanine lenders, preferred equity, and then common equity, which is often you as the limited partner. The lower you are on the hierarchy, the higher the risk, but the bigger the potential return. Always ask, what's ahead of me in the stack? Number 5, what's the exit strategy? Is it clear? Is there a timeline? What happens if they don't sell on time? The deck might say a 5-year hold, but check the documents. Are there penalties for delays? No defined exit is infinite risk. Here's what we've learned from hundreds of family offices. Before investing, they ask, what happens if this deal underperforms? Not the best case and the worst case. Can the deal survive rate hikes, construction delays, vacancies, or slower growth? If the deal sponsor avoids these questions, walk away from the deal. Next, they ask, how exactly do I get paid and when? Is it monthly or quarterly distributions? Is there equity upside on the exit? Any preferred returns? Get clarity in writing, not just in the pitch deck. Next, they ask, what's in the term sheet or the PPM that is not in the deck? This is big. The pitch sells, the docs reveal. Buried in the PPM might be hidden fees, sponsor control clauses, profit waterfalls that favor the general partners. Read them or have someone on your side who will. So let's talk about the 7 deal red flags that doctors typically miss. We're going to rapid fire what to look out for. Number 1, red flag, no preferred return. There is no incentive for the sponsor to prioritize your return. Number 2, high upfront fees. If they make money whether or not the deal performs, you're misaligned. Number 3, unclear capital stack. If you don't know where you sit, assume you're last. Number 4, too many assumptions. Quote, will 3x the rent in 12 months. You got to understand based on what? Show me the comps. Number 5, no sponsor skin in the game. That's a red flag. Are they investing real capital into this deal or are they just riding on LP's money? Number 6 red flag, pressure to wire fast. This deal is closing in 3 days. Hurry, get your money in. High trusting investing is never rushed. And number 7 red flag, no downside scenario modeling. If there's no stress test, it's a marketing document, not a real deal. So here's the mindset shift I want you to anchor. Don't invest in deals you don't understand. Don't delegate due diligence to charisma or trust. You don't need to be a deal expert, but you must understand what you're buying, when and how you get paid, and what protections you have. This is what it means to be an informed allocator, not just a busy doctor hoping for passive income. So here's your challenge this week. Grab a past deal you've invested in or were pitched. Find the preferred return, the promote, your spot in the capital stack, and the exit strategy. Now rate your understanding from 1 to 10. If you score below 7, it's time to learn how to decode these fast. So in episode 10, next episode, we're going to go deeper. This is called the deal flow equation, attracting and filtering smarter investments. Because evaluating a deal is half the battle. The other half is finding the right ones to evaluate. This is the Physician Wealth Framework series brought to you by the Doctors Investor Club. Let's stop trusting blindly and start investing with precision. See you in the next episode.
This is my time. I'm on the rise.